Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good morning. It's Friday, August 29th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So last trading day of the month for August here, and looking at the way markets are setting up here. September, typically, historically, when you go back to 1928, you look at the average return on a monthly return on the S&P 500, and you can see that coming into the end of the summer months here where volume's a little bit lighter, markets tend to drift a bit higher when volume returns in September. Typically, we do see a negative print for September. You go back to 1928, the average decline's been about 1.1%. Now, I do anticipate that any significant material dips in the equity markets should be bought because of the fact you look at the seasonality again going into October, November, December, and January, you tend to see the markets ramp up here. You get about a 0.5% return in October, 1.1% return in November. You get to December, it's 1.3%, 1.2% in January, and then we slide off just a touch here. So that's some of the notes in my notebook, and you should always keep a trading notebook here. Keep and journalize a lot of your thoughts, some of the mistakes you make when trading here, some of the great things you've done, and many times that some of the early exits on some of the losing trades really stand out on why the trading, it's so important to have that notebook where you can identify some of the catalysts changing in your core thesis. Now, if you look at the gold market, gold ETF flows, they've had 5 straight days of growth, and it's the longest winning streak since July 25th. You look at Bank of America, their weekly flows, this is something that I look at, and you really want a reliable source of different research, different numbers, and a lot of quantitative type of data here to look at. But you look at the weekly flows, $19.7 billion into bonds. Why are they going into bonds? Where you're seeing 2-year yields fall, you're seeing yields fall across the board, especially on shorter duration. So they're looking to lock in some of those those rates here that we're seeing as yields start to come off. Now, they also picked up $16.6 billion in stocks, $3.1 billion in crypto, and $1.4 billion in the gold market. So those flows are really going into playing a few different themes here. Declining interest rates, declining dollar. They're looking at the reflation trade with crypto. They're also looking at the stagflation trade with the gold market. So you check on your setup in the markets and the metals here overnight. Futures, they are ticking a bit lower here after this coming off of that fresh all-time high in the S&P 500. I believe there's a lot of traders just booking some of those gains here in the yesterday's close here, taking the rest of the day off. Now, we do have that PCE data coming out, so I would anticipate that the volume would die down significantly once you get past 10:30. You had Fed Governor Waller, he called and reiterated again for lower interest rates, saying that long-term inflation expectations are firmly anchored while the risk of a weakening labor market continues to increase. So traders today, they are going to wait the July release of the core PCE deflator. That's the Fed's preferred inflation gauge. So the S&P 500 down about 0.3% here, trading just below 6,500. You also have the NASDAQ down about 133 points here. That's down about 0.5%, so a little bit of pressure there. You look at European stocks, they did slip. You look at Asian stocks, they were steady with the rally in Chinese equities offsetting the losses for Japan on a little bit of profit taken. The MSCI Asian Index had edged lower here. And why do we care about Asian indices on a metals channel here? Well, the big picture is China has been the world's best performing stock market over the last 2 years. They are also the largest consumer of copper and silver in its raw form. Copper is poised here for the 4th weekly gain, and we haven't really talked about copper too much since we had that big breakdown with the cancellation of tariffs. So we're going to want to see that market start to make a series of higher lows before we look to take any kind of viable action with the clients here that I'm working with on a closely basis. If you'd like to be a client of Blue Line Futures, please send an email to info@bluelinefutures.com. Now you look at the dollar, you look at yields. Swaps markets are seeing about an 85% chance of an interest rate cut next month, and you get the US dollar, well, it's a little bit firmer here, but we do expect to see renewed weakness as the economic data and the Fed resumes its easing in September. We will have non-farm payrolls as the main focus next week, while Russia-Ukraine talks and some of the tariff headlines, they start to take a back seat. And when those tariffs, when there's much more clarity on it, that's where you can see where inflation is at, and inflation becomes well anchored here. So that's what Christopher Waller, he's talking about. Now, gold heading for its 2nd straight weekly gain here, pushing closer to that record high. So we are really waiting for this inflation data. We'll get some volatility in that market coming up to it. So it's likely to show a quicker inflation uptick here in July. And the Fed has really expressed concern about the tariff-driven inflation and the July's inflation print here. This PCE print excuse me, it should be led by the services sector here. So the economic outlook, I looked at a survey that was conducted by Bloomberg, and they're saying that consumer spending, the main driver of the economy, is expected to grow at a pace of 1.1% in both the third and the fourth quarter, while core inflation is expected to peak at about 3.2%. That GDP is now anticipated to increase by 1.1% in that half of the year. What that's important is because the average growth rate's been 1.4% for the first 6 months. So a downtick in that GDP, and that's where you get that slower growth here and you get that stickier inflation. So you start to look at that situation presenting a mix of stagflation in one hand, reflation themes in the other. So that creates dip buying opportunities in both growth and inflation sensitive sectors here and things like the gold market. While the year over year inflation is expected to gradually ease when you get into 2026, it will be above the Fed's target here, but you should start to see where those equities continue to push on higher here on any kind of dips. So you get the ETF flows here. You got 5 straight days here for the gold market, adding about 250,000 troy ounces, and you go to silver, adding about 1.71 million ounces here as we get closer to that $40 mark. Don't look at the futures market if it breaks through 40. You really want to see spot push through 40, and I think that that's where it could really start to trigger some of that bullish theme, some of that catalyst, some of that squeeze buying that people like to talk about over here. So if you got any questions, give us a call here, 312-858-7303. And then remember, futures and option trading, well, it involves risk of loss, and it may not be suitable to all investors. Good luck, good trading.